So what is the daily bias in smart money concepts? As the name suggests, daily bias refers to the overall prediction of market direction and sentiment for the upcoming day. So basically, it's an analysis we conduct on higher time frames such as weekly, daily, and 4-hour charts to better understand market conditions that may not be visible on our entry time frame. Now, most of the daily bias strategies are overly complicated without clear guidance. That's why in this video, we aim to propose an easy step-by-step applicable approach. But first, why do we even need to determine the daily bias? And what is the psychology behind it? Reason number 1. Higher time frame levels are more important. A minor reaction to a higher time frame key level can be a significant trend change in the lower time frames. So before placing any trade, we should check how much room we have before tapping into a higher time frame supply or demand area. This will help us understand how to set our targets, stop losses, and avoid losing trades. Here, on the Euro-Dollar 1-hour chart, we can see a strong downtrend. However, when the price failed to establish a new lower low and rejected this level twice, the market reversed. Now, if we zoom out to the daily time frame, we can see that this area is considered a strong support area for the price. So despite the heavy bearish momentum on the 1-hour chart, we witnessed a temporary reversal. The higher time frame key levels are more crucial because they provide a stronger indication of where major price levels are located and where the market is likely to react due to their stability and reflection of longer-term trends. Number 2, increasing success rate. The best trading setups occur when the higher time frame and lower time frame are in alignment. Imagine, on the lower time frame, we observe a move with inefficiency breaking above the previous market structure. In this scenario, if the price manages to pull back to the order block zone, it would present a perfect opportunity to enter a long position, set our stop below the swing low, and target the next level of market structure ahead of the price. Now, what if the lower time frame analysis aligns with the higher time frame? Imagine if the lower time frame uptrend were part of a bullish movement on the higher time frame. This could constitute a perfect trade, as we have combined higher time frame levels and directional bias with a lower time frame entry setup. With all being said, the psychology behind the daily bias in smart money concepts is to track the behavior of institutional traders so that we can plan our entry setups aligned with this bias. Now that you understand the fundamentals, let me show you how to determine the daily bias using smart money concepts. We use 3 major concepts in identifying the daily bias: supply and demand levels, liquidity areas, and fair value gaps. We're going to use a combination of all the information to determine the next moves in the market. Supply and demand. Who is in control? Now, identifying which side is in control is really important in trading because it can help you avoid many unnecessary losses. How does the system work? It works based on simple mitigation principles. If the price mitigates a demand zone, the demand takes control. And if it mitigates a supply zone, the supply takes control. We always want to trade with the controlling side of the market. Let me show you how. Here we have a moving downtrend with a series of bearish, impulsive, and corrective movements. Every time the market makes a structural break, a supply zone automatically forms. This is the latest supply zone in front of the price. And as long as the price trades below it, the supply is in control. But if the price breaks and closes above this area, the demand takes control, and a demand zone forms. Now, if the bullish movements continue and we witness breaks of structure to the upside, each demand zone becomes a trading opportunity to go long since our bias is bullish. This bullish bias continues until the price taps into this unmitigated supply area. After encountering this area, we no longer consider this market bullish because it has the power to reverse the price and induce a temporary correction. So we have a battle between buyers and sellers. The market could enter a phase of consolidation between the demand and supply until one side regains control again. Now here, if the market breaks the demand zone to the downside, it shows that the supply took control. And we can take short entries until we reach the next unmitigated demand zone in front of the price, which happens to be a temporary reversal point for the price. On the other hand, if the price breaks the supply area to the upside, it shows that the demand is in control, and we can take long entries with confidence until we reach